A very good afternoon to all our viewers. So welcome for the second session of Introduction into Fundamental and Technical Analysis. So last week we discussed about the income statement, and for anyone who's joining new today, just to give a background about this program, what we're trying to do here is uh, teach the very basics, the very ground level basics of fundamentals and technical analysis to whoever who is investing in the Colombo Stock Exchange. So anyone who's joining new, if you have any finance background, yes, still you will find this useful. Bear with us. We'll be going with the very basics in the very first few sessions. So just a quick recap of what we did yesterday. I'm sorry, last week. So by the way, my name is Charitha for anyone who doesn't know me, and I will be running through the fundamental analysis and followed by Mr. Saliya. Okay, a quick recap of what we did last week. Last week we discussed about the income statement. As you all know that there are three main key financial statements. The income statement, the statement of financial position or the balance sheet, and the cash flow statement. And I just briefed you all about the accounting system. There are four types of accounts in accounting system: income accounts, expenses, assets, and liabilities. And the income statement summarizes basically the incomes and the expenses and try to calculate the profit or the loss an organization have derived. So I said that when incomes are in excess of their expenses, the company will make a profit. When incomes are less than its expenses, the company will make a loss. Very logical, very simple to understand. And when selecting a share, we mentioned the fact that look for companies where there is strong profit growth. Now, bear with me, the terminology that I'm going to use throughout this presentation will be very basic. That's mainly for the benefit of those who doesn't have a accounting background. So I'll try to keep it very simple as possible without going into more technicalities. Okay, then we touched upon the format of the income statement, where we discuss about how to analyze it, how to do a vertical analysis and how to do a horizontal analysis. Horizontal analysis is where you can compare the current year performance with the previous year performance. For example, the revenue of this company have grown by 18%. That's what you call as horizontal analysis. So you have to see whether the incomes have grown, how have the expenses behaved, have the incomes grown at a higher rate than the expenses, and how profitable the company is. Then in addition to that, you have to do vertical analysis. Vertical analysis is you can calculate any figure in the income statement as a percentage of a base figure. So the most common base figure that have been used for vertical analysis is that you use the revenue figure as your base. So what you can do is you can calculate your gross profit as a percentage of revenue and see how much is my gross profit when compared to revenue. So that you call the gross profit margin. So you can compare the gross profit margin of the current year with the previous year and see whether the gross profit margin have improved. So gross profit margins improving is a positive factor. So in addition to that, you can calculate your operating profit as a percentage of revenue, and you can calculate the operating profit margin. So operating profit is the profit that a company have earned through their normal course of business, excluding the incomes generated from finance, basically the finance income, interest income. Then another important thing to look at is profit before tax, right? Before the company paid taxes, how much profit have they earned? Have the profit before tax increase or reduce? And finally, you look at the bottom line of the company, which is the net profit attributable to equity shareholders after paying taxes to the tax authorities. So that also you can again calculate it as the net profit margin, where you divide the net profit by the revenue figure, right? I'm just rushing through quickly because we discussed these things detailed last week. So then looking at the main ratios we calculate using the income statement. So the profit margins I've already revised, where you divide the profit figures by its revenue. It's a vertical analysis technique, and calculate the profit margin and compare it with the previous year and see whether the profit margins have improved. So profit margins improving is a good thing. Then you can calculate the earnings per share. So what you do is basically you divide your profit attributable to equity holders Let me go back to the statement. Here you can see profit attributable to owners of the parent. So this is the profit which is attributable to the equity shareholders. This is the profit that can be shared amongst shareholders, right? So what you calculate as earnings per share is you divide this particular figure, in this case 1.19 billion, by the number of shares in issue, right? So as the name suggests, it's earnings per share, right? Now this is a common indicator that have been used by investors when making investment decisions. So you look at the EPS, earnings per share. How much is this company earning for a single share? That's the basic meaning, the simple meaning. And you see whether the EPS have increased or reduced. So when you get a report, what is required for you to do is not actually to calculate this, because this figure will be given to you. What is important is the interpretation part of it. How do you interpret this? So EPS tells you how much profit is this company earning for a single share, right? So don't really worry about this formula. This is included for the benefit of whoever is interested. You need not calculate this because this will be given to you in the quarterly financial statements, annual reports, as well as research publications published by any research company. Then the third one we discuss is the price earnings ratio, commonly known as the PE ratio. So what does the PE ratio tell you? How do you calculate it? You divide the share price by the earnings per share. Now we discuss how to calculate earnings per share. Let's take a simple illustration, the one I took last week. If a share is trading at 10 rupees, and if the company is generating an earnings per share of 2 rupees, that means you are paying 10 rupees to buy a share which earns 2 rupees of profit for a year, right? So you are paying 10 rupees to buy a share which earns 2 rupees profit for a year. So if you when you divide 10 rupees, which is the share price, by its earnings per share of 2 rupees, you get a multiple of 5 times. So what does this tell you? How to interpret this? PE tells you, now again, you can interpret it in different ways, but I will use a very simple way of interpretation for anyone to understand. It tells you how long in number of years would it take for the company to earn back the price that have been paid for a share. In very layman terms, you paid 10 rupees, the share is earning 2 rupees. So that means roughly for a year, if it can earn 2 rupees, it will take roughly 5 years for the company to earn back the share price. This is predominantly on a theoretical basis, right? Because when companies earn more profit, they can earn back that price in a shorter period. So we assume, okay, if the same level of profits are being maintained by the company, roughly it will take 5 years to recover the share price, to earn back the share price, right? So normally when the time period is shorter, the risk associated is also shorter, is less, right? Long term is uncertain, short term is more certain, right? So if a company has the potential to earn back the price what you pay in a shorter period of time, that means there's less risk associated with that. But if a company is taking something like 20 years to earn back the share price you paid, then there's a lot of uncertainty, because 20 years is long away in the future. You don't know whether even the company might exist 20 years, right? So it is generally preferred, a low PE share is more suitable, generally preferred, but it is not the criteria for investment, right? As I said, there can be different other interpretations, because higher PE also tells you that there's higher confidence among investors to buy that share. Shareholders are willing to pay a higher multiple to own that share because they believe in that company, and that company can earn higher profits in the future. Based on that expectation, people might accumulate more shares and the PE multiple can go up, right? So don't get the misunderstanding that it is low PE companies that are always best. There's no such thing. Yeah, low PE multiple companies, the risk is less. You have to look at the growth potential of the company in addition to that. Okay, so this is where we stop. Now let's move on to the second financial statement we are going to discuss, which is the statement of financial position, or very well known as the balance sheet. Now in the outset, I said that there are 4 types of accounts: income, expenses, assets, and liabilities. So incomes and expenses were summarized in the income statement to calculate the profit. So now we are left with the other 2 types of accounts. assets and liabilities. So the statement of financial position, or I will use the word balance sheet. The balance sheet is where you compare your assets with your liabilities. How much of assets do I have? How much of liabilities do I have? That is one way you can interpret the balance sheet. You can define the balance sheet. Another way is that the balance sheet will tell you how much assets you have and how these assets are being funded, right? Now, normally when you talk about the funding of a company, there are two main sources of funding. The first one is the shareholders funds, right? That is how much the owners have invested in the business. Then the other source of funding is borrowed funds. How much have the lenders invested in your business? For example, if you need 1 billion rupees to start a business for your plant and machinery and vehicles and other things, you need 1 billion rupees. You have 700 million with you as your funding source, your owner's capital. So what you can do is, I need 1 billion to start this business. I have 700 million. The 300 million you can borrow from a bank. So your assets, 1 billion worth of assets are being funded by two parties. 700 million by the owners, 300 million by the lenders, right? So the balance sheet will tell you this composition. What are the assets and how are they being funded? How much belongs to the owners of the company, the equity shareholders, and how much belongs to the lenders, right? So the statement of financial position is a summary of all assets owned by the business and its liabilities. Now in the income statement, we net off the expenses against the income to calculate the profit, right? In the balance sheet, you don't do such a thing because assets and liabilities will continue to the future. You can't set off your assets and liabilities and prepare a statement like that. This is just a snapshot of the company which tells you the financial position. What is in this business? What are the assets and how are they being funded? So the second point, it says that at any particular moment, it shows you how much money you have left over if you have sold all your assets and paid off all your debts. Now in that illustration I took, you have a business worth 1 billion and how you have funded that is using 700 million of your money and 300 million of borrowed money. So if you wind up this business, if you want to close down this business, what you need to do first is you need to settle your liabilities. So out of your 1 billion worth assets, the entire 1 billion doesn't belong to you. You need to settle 300 million of debt which you have borrowed. So what you do is from your assets, you deduct your liabilities. Then you are left with your net assets. Now that is an important word that you should remember. Net assets. Net assets is assets minus total liabilities. I have 1 billion worth of assets, but I have 300 million worth of liabilities. So when you deduct your liabilities from your total assets, you get a figure called the net assets. So that is the amount of cash which is left for the equity shareholders of the company if the company goes into liquidation, right? So I will use a very simple word without liquidation. I'll say if the company winds up and closes down the business, net assets is the amount which is left to be distributed back to its shareholders. Now, in the case of income statement, I took a main criteria as the profit growth is something which you need to look for when you are investing. Similarly, in the case of the balance sheet, you need to look at the balance sheet position, the composition, how much assets do they have, what are the liabilities, and what are the how much is the shareholders funds. So you should select one which strong balance sheet positions, strong balance sheet growth. So let's look at the format of a typical balance sheet. Now the balance sheet is mainly divided into two parts. On one side of it, you will have your assets. On the other side of it, you will have your equity and the liability. Right now, I said the balance sheet tells you what are the assets that are there and how they are being funded. Now let's look at this. This company have total assets worth 24.4 billion. 24.4 billion. Now this 24.4 billion is funded in this way. The shareholders own 14 billion. That's the figure called the total equity. So in the balance sheet, when you go to the bottom part of the balance sheet, there will be something called the total equity, 14 billion. So this is how much is belonging to the shareholders of the company out of the total assets. The balance 10 billion is total liabilities, right? So when you add 14 billion plus 10 billion, you get 24 billion, and that is how these assets are being funded. So all these assets doesn't belong to the shareholders. Part of it belongs to various other lenders and other parties, right? So there can be trade payables, right? So many liabilities can be there. Okay. So in the balance sheet, what you need to really look at is how much of assets are there and what have happened to them. Have the assets grown or have the assets declined? Have they disposed any assets? And what is happening to the liabilities? Are the liabilities increasing, right? And for what purpose these liabilities are being used? So when you go to the notes in the balance sheet, you can take a detailed look into the liabilities, what these liabilities are and for what purposes these are being used. So you have to look at companies where there is strong balance sheet growth. So especially look at the total equity, whether the total equity figure is growing, because total equity is what really belongs to the shareholders of a company, right? So please concentrate on this line, total equity. I don't want to go into more details. This is the total equity belonging to shareholders, but what is attributable to the equity holders of the company is the one which says equity attributable to owners of the company, 12.2 billion, because there's a non-controlling interest part. So in the initial sessions, we are not going to discuss about non-controlling interest, because if you don't have accounting background, you might get little confused with that. So for simplicity, I will stop here in terms of the balance sheet. Look at the assets, look at the liabilities, and see what is happening to the equity, right? So in equity, there will be various components: stated capital, capital reserves, general reserves. Don't worry about them right now. Just look at the total equity figure and see what's happening to the equity figure. Is the equity figure growing? Right. Now, what are the ratios that are associated with the balance sheet or the statement of financial position? The first one is net assets value. Now, you all are familiar with the term net assets. Net assets are assets minus total liabilities, or in other words, the total equity attributable to the shareholders. So, normally in the balance sheet at the very bottom, they will give you this figure called net assets value per share, right? Or just say net assets value. So what they do is they divide the total equity figure or the total net assets figure by the weighted average number of shares. So forget about the part weighted average. Just we'll go with the term number of shares. You divide the total equity figure of that company by the number of shares in issue. I'll take a very simple illustration. There's a company which has 100 million worth of net assets. Net assets are 100 million. That is when you set off your assets against your, when you set off your liabilities against your assets, you are left with 100 million. Now, this is the amount which can be distributed amongst the shareholders. So 100 million is left as net assets, and there's 10 million shares in issue. So if 100 million is to be shared amongst 10 million shares, how much is attributable to a single share? Simple as that. You divide your 100 million net assets by the number of shares in issue. So 100 divided by 10, you arrive at a figure called 10 rupees per share. So this company has a net assets value of 10 rupees per share. In other words, if the company goes into a liquidation on a theoretical basis, based on the reported book value, each shareholder would get 10 rupees on a theoretical basis. In a practical note, this can change, right? Because we are looking at the present book value only. Okay, so net assets value is how much of assets are attributable to the equity shareholders on a per share basis. Okay, so I'll just recall if someone is a bit unclear about it. What I said is you calculate your net assets, that is total assets minus total liabilities, or you can directly derive this figure from the balance sheet. Let's go back to the balance sheet. So in this company, the total net assets are what? 24.4 billion, that is this figure, minus right? 24.4 billion, this figure minus the total liability figure 10 billion. So 24 billion minus 10 billion, 14 billion is your net assets. So that can be directly read as the equity figure in the balance sheet, right? This is the net assets of this company. But for equity shareholders, what we really take out is the equity attributable to the ordinary shareholder. So 12.2 billion. So what you calculate as net assets value per share is 12.2 billion divided by the number of shares in issue. So that will tell you how much each share would get if the company goes into liquidation. Okay. So let's move on. Okay, so why do we use the weighted average number of shares? Now, if the number of shares have changed during the year, you have to calculate the weighted average. Now, maybe that the company have issued new shares during the year. So you had 100 million shares at the beginning of the year. During the year, they have issued 25 million new shares. So at the end of the year, there is 125 million shares. So then what you do is you can't take 100, you can't take 125. You take the weighted average number of shares. So don't really worry about how to calculate this because all these figures are being given to you. What is important to you as an investor is the interpretation of it. You should know what does NAV tells you. NAV tells you what is the true value of this share if the company goes into liquidation. So we'll take another illustration. If the NAV of a company is 10 rupees and if the share is trading at 50 rupees, you are paying 50 rupees to own a share which is worth 10 rupees. So you have to see what is the share price, what is the net assets value, right? So net asset value tells you the true value of that share, and that you need to compare with the market value and see whether I am paying a huge premium or a smaller premium, or is it trading below the net assets value. So to decide that, we calculate another ratio called the price to book value. This is in principle very much similar to price earnings ratio, the PE ratio. In PE ratio, what we did is we divided the share price by the earnings per share, right? That is, you divide the price you pay by the amount of earnings that share is earning. Okay, then you tell how many years of earnings are you paying to buy that share. In the case of price to book value, you divide the share price by the net assets value. Now I said, if a company is trading at 50 rupees a share, and if the net assets value of that company is just 10 rupees a share, you are paying 5 times the real value of that share. I beg your pardon, I will not use the word real value. You're paying 5 times the net assets value of that share. The share is worth 10 rupees according to the book value, but you're paying 50 rupees. So are you willing to pay 50 rupees for something which is worth only 10 rupees? That is the interpretation of price to book value. So you need to look at the price to book value as well, right? So generally, low price to book value means stock is undervalued. Now we'll take another scenario. Share is trading at, I'll say 5 rupees. Net assets value is 10 rupees. You are paying 5 rupees to own a share which is worth 10 rupees. So you are paying less than the real value. So if the price to book value is less than 1, theoretically we say that the share is undervalued. So share is undervalued does not necessarily mean that it's a good share to buy, right? Because you need to look at various other things. If the price to book value is low, and if the company is fundamentally good, if their profits are growing, right, and trades at a low price to book value, then it could be considered as a good buy, provided all other ratios are also favorable. Right, now we are going to learn more ratios as we move along. If everything is favorable and if the share is trading at a low price to book value, yes, we could consider that as a buying opportunity. Right? Just because the share is trading at a low price to book value, it doesn't mean that it's a good share to buy, because it might be trading at a low PBV because of something wrong with their profit earnings, right? Or there can be various other non-financial factors contributing to it. So you can't use any of these indicators in isolation, right? You have to use them all together when you're making a decision. So I'm running bit longer than scheduled. I wind up with the last ratio, that is the debt to equity ratio. What you do is you divide your total debt by your total equity, right? So debt is basically borrowings, right? There are various ways of doing it, but for simplicity, I'll say you take all your interest bearing borrowings and you calculate that as a percentage of your total equity. So I have in that particular scenario I took, where I invest 700 million into my company, and when I borrow 300 million, my debt to equity ratio is calculated as 300 million debt divided by the total equity of 700 million, right? That will give you the debt to equity ratio. So debt to equity ratio also interpretation depends on so many things. Now, if the company is operating in a high interest rate environment, if the interest rates are very high, a company with a higher debt to equity ratio is generally not considered as a good investment opportunity. But having said that, you have to look at various other things. Why it is generally not considered as a good opportunity? Because when the interest rates are high, if your company is highly geared, that means if your company debt position is very high, you have to pay high interest cost. So when high interest is being paid, less amount of profit is left for the ordinary shareholders, because ordinary shareholders can be paid a dividend only after paying the interest. So if the interest rates are high, and if the company's borrowing position is also high compared to its equity position, that means a major portion of their earnings will go towards paying the or servicing their debt, paying interest, right? Therefore, there will be very little amount of profit left for to be distributed to shareholders by way of dividends. In an environment where the interest rates are low, now the current situation, interest rates are low. So even if the company's debt to equity ratio is high, it is not a real bad thing because the interest cost is very low, right? So there are various use of looking at the debt to equity ratio. I just gave you all the most basic understanding why you need to look at it, right? Now, I don't want to name out companies. There are certain companies listed in the stock exchange which are highly geared. Highly geared means their total debt is sometimes more than the total equity. So the debt to equity ratio is more than 1 time, right? They have more debt than equity. So when that happens, they are more, majority of the profit goes to servicing the debt and less is left with shareholders. So that is another indicator you can look at, right? So the debt to equity also tells the gearing and the risk which is associated with that. Okay, so I will stop here for today. This is session 2. Now we have discussed the basic ratios of the income statement and the balance sheet. And now let me hand over the presentation to our technical specialist, Mr. Saliya.
Thank you, Charitha. Okay, let's move on to the charts here. Okay, last week, welcome all of you. I'm Saliya. Last week, as you all know, or rather could have recollect, we brushed through how to get connected to the investing.com, and then how to move into the chart window of a stock. And this is how we did that. We moved to the, we clicked on the technical chart icon. Then we clicked on the zoom icon. And as a result, we went into the chart window. In the chart window, we ran through all the features or rather all the key features that are available. And we change the charting style to candlesticks, and we explain about candlesticks as well. Then we moved into brushing through the trends. There are three types of trends: the uptrend and the downtrend, then the sideways movement. Thereafter, we brush through what support and resistance, or there is something called support and resistance. And also we mention about the breakouts. Now today, we are going to like work up from there. Whereas, you know, what we are now from today, we will be moving a little bit deeper to what support and resistance is all about, the breakouts, and also we will be using or touching on the trend lines, which we can use in order, or rather we normally use to identify the support and resistance areas. So now let's move on to one of the famous stocks at the moment, LOLC. Along with LOLC, we'll work out all these very important basics. Now, last week, when I touched on the basics, we spoke about the time frames of the charts. At the moment, by default, we are on the daily chart, but of course, you can use different time frames, as per your analytical strategies that we are. So we are now in the daily chart. Before coming to the current situation, let's move a little bit further by minimizing it. And look, let's go to time period in the past, like this. This is in 2020. And let's start from the beginning of post-COVID market. You know, after that massive lockdown from March onwards, we started on the 11th of May, and this is where it is. If I use these tools to highlight that area, this is where we were. Right. So last week, I mentioned that in an uptrend, first you focus your attention to the lows, right? First, the lows have to start increasing into a high-low formation, followed up with the highs. In an uptrend, that is very important, and you will realize as time goes on as to why the higher low formation has to come before the higher high formation. So once you move into an uptrend like this, then you come into a sideways movement. Right? You come into a sideways movement. Then again, you can see that there is another uptrend. Then again, we can see that there is another downtrend before a sideways movement. Then we see another sideways movement, and then again an uptrend. In between, you can see that there is a give me a moment. within this uptrend, you can see that there is another sideway movement over here, another sideway movement over here. Now, you need to train your eyes based on these sideway movements and the trends, the directions, right? The down and the up, upward, downward and the upward direction. Thereafter, we need to understand that in that sideway movement, it is at times called the support, and at times it's known as the resistance. Now, as far as the support, what is support? If somebody asks how to explain or how to understand what support is all about, support is when a downtrend pauses due to a concentration of demand or buying interest, right? In a downtrend, you come into a pause due to a concentration of demand or buying interest. Now, when I mentioned, if we see this area, this is a downtrend. You have high, lower highs and lower lows, then it pauses here and goes into a sideway movement. And this is known as a support, right? And now, as you can see here, just because there is a support after a pause, there is a support, that doesn't mean that the prices are going to turn upwards, reverse to the upside. That won't happen all the time until such time that that downtrend or the primary trend that the stock is in reversals, right? So as time goes on, we will be looking at how the reversals are taking place. But over here, after the downtrend, you can see that there is a sideway movement. Now, this sideway movement may not, be a horizontal. It does not necessarily mean that any sideway movement is a horizontal. I mean, basically a straight kind of a sideway movement. It won't happen like that, right? Of course, there are situations where it happens, but most of the time we can see that the sideway movements have a diagonal formation, as as we can see. Thereafter, we can see over here, after this sideway movement, again, you see a downtrend. Thereafter, again, a sideway movement. And this, within this sideway movement also, you can see that there are waves or rather fluctuations, right? And remember, last week also I mentioned, and always remember, when you're interested in understanding technical analysis, we always need to remember that prices have a tendency of flowing within waves, right? It has a tendency of flowing within waves. So if you understand how the ups and downs of those waves are taking place, it will be very useful from the start itself to progress and develop your skills in technical analysis. So after this down sideway movement, we can see that from here there is a breakout and the prices have started moving up from here. You got to bear with me. This, I'm not so familiar with using the tools from this computer, but next time I will be using what I'm convenient with. So now we can see that there is an uptrend at which point this sideways movement was broken out and the trend started continuing. Now, when we are looking at sideways movements, these support and resistance areas, right? We initially, when we are training ourselves, we will be using the lines that I just now drew, and we have a system of drawing those lines in order to understand the support and resistance levels. Other factor in understanding the support and resistance areas is to know that even in an uptrend, there is a support and a resistance level. Even in a downtrend, you have the support and the resistance levels, not only within sideways movements. Other thing that we need to educate ourselves is that at at every given support and resistance level, there needs to be a breakout. It can be either from the resistance, a breakout, or it can be from the support, a breakout. Now, until that breakout takes place, we do not consider that the trend, whether it's continuing or reversing. In a downtrend, when downtrend when the trend reverses, when the trend reverses only when the resistance point in that downtrend is broken out, then only a reversal takes place, right? In a downtrend, and after the downtrend, if you see a sideways movement, either in the downtrend or in the sideways movement, there has to be a breakout from out of the resistance level. Then there is going to be a trend reversal. That's exactly what happened here, right? The trend continued because this downtrend that started from the top over here, paused at this point, then went into a sideways movement, right? Until the prices broke below that, which continued the downtrend, right? So let's use the trend lines to kind of draw the channels, or rather draw the support and the resistance levels, so that we will be able to work through to understand how the trends are reversing out of the support and resistance levels. When you are drawing the trend lines, what we do is at least a minimum of 2 points of either 2 points of low values, or 2 points of higher values have to be connected, right? So in this case, if we connect one, this point as the first low point, and move it up and connect the second point here, by touching those 2 points, we just extend the line like this. We can stretch out as much as we want, because there are instances where this line which we are stretching up also will be important, right? So basically, I use the low edge of this candle and the low edge of this candle in order to draw this line. Now that is by joining the lows, right? And now this we have to understand that in an uptrend, since you see high-low formation, this line is going to act as a support until a breakout below that trend line takes place, right? Then on the top, on the opposite direction, we will be using another 2 high points for us to understand how that uptrend is progressing, right? Here I'm using this high point and this high point, and I can just keep stretching this as much as I want. So here you can see now the prices. When you monitor these two lines, the prices broke below the lower line. So what we normally say is that the prices broke below the support trend line, and as a result of that, you can see that the trend has reversed. This is the reversal of a trend. Okay, the reason as to why this is a reversal is because the higher low formation at this point broke and changed to the opposite direction and became a lower high formation. Yeah, uptrend changed and became a downtrend, right? So now what we do is we will be first using the highs. Now when we are analyzing the uptrend, first we are using the lows, then followed up with the highs. Conversely, we will be using first the highs on a downtrend, followed up with the lows. Now this point and this point I will be connecting like this. At the same time, I'll be connecting this point to this point. Now, in this scenario, you can see that the highs were connected with this line, but at this, out of this candle, we can see that the wave or that trend is moving away from that line, breaking out of that line. And at the same time, you can see when the prices are moving within a different direction, right? Within a different direction, you can notice that the line that connected the lows over here is acting as another kind of a, I mean, is blocking that price fall right here. And because of that, we can understand that this line that we have drawn connecting the lows, as I mentioned earlier, is acting as a support line, right? Oh, here, the low, the line that connected the lows is a support line. This line which connected the highs is a resistance line. And here, which connected the highs is a resistance line. The lows that got connected by this line is a support line, right? When we were using these 2 points, we never knew that this development is going to happen, right? Now that since we are kind of for study purposes, we are doing this in a real market. I mean, when you're coming to the current situation and using these lines, right? you need to understand that, you know, the basic condition of using the lines is by connecting 2 points. So wherever it is, when you're connecting the 2 points, right, you do not, I mean, when you are in the current situation, the current position, you will not understand what is going to take place into the future. So that's another important aspect of technical analysis, is because you do not predict the future just because you have drawn the lines, right? Just because you have drawn the lines, just because you have some basis, you are not going to predict. We are predicting only if those lines, if those areas are respected. We don't really, we don't care what is going to happen to the stock. We don't go behind the stories. We only watch the price action based on our analysis, right? By using the prices and the volumes, right? So now what is happening here is that you see a significant low here. Then at the same time, you see lows here and lows here. Now, I'm not going to use this low, you know, at first. I will be using the previous low from this low to this. And while connecting, touching that, I will be stretching the line forward. Now, when I'm stretching the line, and incidentally, this is a support line, you can see that this, you know, after this low, the prices started moving up. And then even with a high-low formation, with a different angle, you can see that the prices are going up. In between, this candle hit a low and touching exactly that support line. That is what a support line is all about, right? So at this moment, nothing happened. The trend continued. While the trend was continuing, you can see with a impulsive candle, meaning a very bullish candle with a larger range, broke out of this resistance line as well and went up, you know, to even test this line that now acts as a resistance line. But it didn't go up to that level, made a reversal, and started another downward direction. And you can see on one day that this particular day, the close respected the line, which was now the support line. Here, it was a resistance line. This area, of course, we used to connect, or rather draw this line. And we can see here, this line acted as a resistance line. Thereafter, when the prices were falling, the line succeeded in becoming a support line. But the following day, with a gap, we saw it coming down, the prices continuously coming down. And again, this support line, which was respected here, once again got, you know, kind of tested as a support line, but the prices rejected. 2 days, the prices came down below the support line, but there was a retest over here, which is now a resistance line, then started to continue the downward trend, right? So thereafter, we can still, I mean, from there onwards, we will be using the lows. Now, this is a significant low. So I'm connecting that significant low with another significant low of my choice, right? There is no hard and fast rule. Anybody can use whatever the significant low that he believes in, right? And here you can see when I'm using this low and stretching it forward. Then I will be using this significant high and this significant high to connect the highs and which is going to be the resistance line. And you can stretch it as much as you want, right? So here you can see I used this low and this low, and over here it took support. The prices respected that line, but then tried to go up and test the resistance line, which is downwards, but broke out of the support line, came further down up to this significant low. Over here. Right. Now, this can be stretched by focusing attention to this low and this low. You can stretch that. And at the same time, there is another significant high here and another significant high here. So I'll be connecting those two and stretch forward. Right. Then while the prices were moving sideways within those two lines, we can see that there is an uptrend, in between those two lines. So I'm going to connect this high-low formation also with a trend line, where I'll be using two basic points. I'm not going to use this. I'll be using this line and stretch up, stretch forward like this. Right? So at any given moment, when we are drawing the lines by using the low points or the high points, we need to understand that we are looking at the support and the resistance and how the prices are behaving within those two areas, whether the prices are breaking out of the resistance line or whether the prices are breaking out of the support line. Now, you need to, if you are interested in understanding the basics of technical analysis, you need to make use of these lines, because even when you're moving into advanced analysis by using many different tools, having a thorough knowledge of these lines will help you. Remember, these lines that we are drawing are the support and resistance lines, nothing else, right? Because as time goes on, you will understand why these lines are important and how we will be using these lines further on to understand different types of features or different types of I would say, important analysis, so that we will be able to identify, sometimes even project what is going to happen, if those levels are going to be respected, right? So, okay. Apart from this, if you look at these, if I'm just going to touch a little bit further on these lines, if I stretch these lines, you would have noticed that how the prices have broken out of these lines as we moved on, right? So you can see here it tried to break above this resistance line. It didn't work. Then it came down, tested this line again, came down, right? Broke out of this support line. Then again it went into the two lines, within the two lines, and we can see convincingly the lines, both of those two lines were broken out, and rest is history, right? Now, there is a secret as to why we are using these things, right? If you're a smart technical analyst, right, these little indications that you are going to get out of your own lines, out of your own support and resistance analysis is going to reward in a big way, right? Take this swing itself, this trend reversal, right? And this strong breakout, right? You would have, if you had, made use of that, you can see that the amount of money that you could have made. Amount of money you could have realized just by using those lines, right? Here, there is a breakout, and this is where it went up, right? So the final thing that I want to touch as far as these lines and the breakouts are concerned is the volume, right? In the case of the volume, why the volumes are important when there are breakouts, right? Now, based on this, right, these two lines, you have another, if you within these lines also, you have certain levels where you can monitor, right? Now over here, you have a high candle, and this is also significant because the wick is longer. Here the wick is longer, so you can see it very significantly, and this candle is also the same. So you can use these two candles just like what I did earlier and connect them this way. But at this point, whenever we are looking at the candles, we are very, very critical in looking at the volumes, right? Now, this line that you can see in gray is the average volume line, right? And anytime when the average, when the volumes are moving above the average volume line, right, we consider that as an important aspect for the price extension, right? So when we can see that there is a movement like that, the tendency of the trend continuing to that direction is going to be very strong, right? So here, if you can see that when now this line that I just now drew, right, when the prices were extending, you can see how the volumes were behaving, right? The volumes also started increasing significantly, and the prices started moving further up, right? But at this moment, when the prices were falling, right, you can see that the volumes also are reducing over here. And when there is a sideway movement here within these two lines, right, you can see that the volumes are receding, and the prices are going within a higher low formation. But if you look at these highs here, they are almost like parallel, almost the same values, right? So you can see thereafter over here, by looking at these highs, you can see that there's a breakout. Along with that breakout, the volumes are also increasing. And if you take this breakout, which is a significant breakout, right, the volumes also have increased. So it is very important for you to study how the volumes are behaving when there are breakouts, right? Like this over here, when this very important breakout took place, you can see how the volumes behave. Coming to the current situation, also right now, you can make use of the lines to join the significant lows. Now here, this is a significant low. This is another significant low. You can connect it. Right, so this is acting as a support line. Here, this significant high against this significant high, once again, is acting as a support line. After, now this is a resistance line, there's a breakout, and right now it's acting as a support line. Way forward, we'll be, we will understand whether that's going to succeed as a strong support line. At the same time, we can use this high with this high and stretch it further to understand whether this is going to act as a support line. Right, so that is how we look at the trends. Within the trends, how the support and the resistance lines are going to behave, and that is purely by using the trend lines, where we will be looking at the angled trends, right? But within horizontal support lines, we will be looking into that next week, how we are using the horizontal lines and finding out where the support and resistance lines are going to be and how the prices are going to behave within that, within those lines, right? So basically, if you want to kind of get an understanding about the way the prices are going, way the direction is going to behave, right? We need to understand how the prices are behaving within the trends and support areas, rather trends and the sideway areas, because it is going to be very important even when we are using indicators. So with that, I will wind up in order to meet up with you again next week. Thank you very much.
Right, thank you, Saliya, for that excellent presentation. So again, we will be meeting next week with another session of fundamental and technical analysis. And now the floor is open for any questions. We can take a couple of questions because we have run out of time. So if you have any questions, please send it in the Q&A.